Hi everyone, on today's episode I'll be giving you 5 tips on how you can maximise the return on your rental property. Hi everyone, I am Ethan Rushop, and on today's episode I'll be going through 5 simple tips that nearly every single investment property owner will be able to use to maximise the return on their rental property. I quite often get the question of how do I make more money off my rental property, or how do I maximise my refunds on my rental property, etc. So what I want to do is cover some simple tips that apply to both people with positively geared properties and negatively geared properties. Let's get into it. So tip number 1 is keeping your settlement statement document when you first purchase your property. So this will be used 2 times. Initially, this document carries some really important information about adjustments that they make for council rates, water rates, emergency services levy, etc., depending on which state you're in. And it also then comes into importance later on down the track when you sell the property. So when you initially have that first year of rental, this will include some of those expenses as mentioned previously, and these will be able to be claimed potentially in your tax return. So it's important you've got this document to make sure that you're capturing all the actual expenses you've really paid. Then when it comes to sale, this is where people get caught out. Quite often I'll have a client that will say, oh, I've sold a property, and I'll ask, when did you initially purchase it? And normally they have a rough idea of the purchase date, but maybe not always the exact amount, etc. Or they might know, oh yeah, we paid 250 grand, but they don't know any of the fees that were attached. So this settlement statement will outline stamp duty, might have a title search, etc. So these fees will all be added to your cost base. So the higher the value of the property, the higher some of these fees get. And obviously it depends which state you're in as to how much is stamp duty, but that can be quite a significant fee. So now when you sell the property, when you put the initial cost base figure in, you're going to have those fees as well as the actual purchase price of the property. This will bring down any capital gains you've got, therefore bringing down any capital gains tax, and therefore increasing the overall return on this property. Just a quick interruption to this video. I really hope it's providing value to you, whether you're a current property investor or whether you're thinking about investing in property. If it is, I'd love to see you drop a like on the video, maybe even leave a comment on what parts you found helpful. And as always, if the video is helpful, I'd provide a lot more content like this, so I'd love for you to hit that subscribe button. Now back to the video. Okay, so tip number 2 is considering getting a depreciation report done. So what a depreciation report does is there's a few different companies that will come in and do this, but pretty much they go through the entire house and value all the plant and equipment and the capital value of things. So that'll include your fixtures and fittings. So they'll go through and go, okay, the oven is worth this much, your blinds are worth this much, your air conditioner is worth this much. So they come through with a full asset listing, which then these assets can then be depreciated. So what they do, they calculate a couple different methods for you and give you year by year amounts that you'll be able to claim in your rental schedule. So what's great about this is stuff that's already included in the purchase price when you've purchased a property. You're now getting to claim these each year, bits and pieces of it. So it's great to reduce your taxable income in those years, because obviously you're going to be claiming extra expenses. So while this will make your rental property on your tax return sound like it's made less profit, this therefore increases your tax return, therefore adding some more income that you can really add to the overall return of the property. So you've got to be careful here though, because there were some changes made a few years ago as to what properties and what assets would be eligible for this. So the main changes were that older properties you can no longer claim depreciation on previously used or second-hand assets. So the people this normally suits are people that are building a brand new property to rent, or someone that's recently purchased a brand new property, etc. Because these obviously have a lot of assets that are going to be at full value because they're brand new and they're eligible under these ATO rules. The other thing that a lot of people aren't aware of though with the depreciation schedules is that whatever assets you're claiming will come off of your total cost base as you've claimed these. So it will result in normally you having a higher capital gains at the end. So quite often this isn't explained very well to people, but while this is a bit of a disadvantage, you're still better off to have $100,000 in capital gains than $100,000 of assessable income. So the reason for this is your capital gains. If your asset is held for over 12 months, then you'll get the 50% discount. Therefore, you're only paying tax on 50,000 of that. So this is obviously better than paying tax on the full 100,000 if it was assessable income. Tip number 3, keep copies of everything in relation to expenses for your property. People quite often come to me and go, oh, I spent lots of money on repairs, but I didn't keep any of the receipts. Well, therefore, you can't claim them if you haven't got the records. So it could be just minor stuff like gardening, but you might pay this each week, you get a receipt for you, make sure you claim it. Little repairs such as electrical works. You've paid an electrician, keep the receipts. And then it's the other stuff that people often forget. Oh, they've had to go buy some new plants for the garden, or they've had to go do some work on the house that they've done themselves, but they've got expenses such as they might have materials to do the work. So keep that kind of stuff. Therefore, you're maximising the deductions you're claiming, therefore reducing the profit that you're going to pay tax on, therefore increasing the overall return on that property. So number 4 is ensuring that you're paying the best rate of commission to your agent. Now, I don't want this to get confused with, oh, I just want to pay the lowest fees and therefore maybe you're not getting the service. But it's speaking to whoever your current agent is and making sure that they're giving you the best deal possible. You never know by asking whether they'll reduce that rate down, because quite often they do have a little bit of margin there to reduce that down. So what you also need to be careful for is making sure you understand all the different fees that are included in your commission. So you might have management fees, you may have letting fees, so when the property is initially rented out. You might have an admin fee. Some are still charging postage and printing fees when they print out statements for you. So have a real understanding of all the fees that are included in your property and making sure you're asking that question every 12 months of can they be lowered at all. And be careful as well if they're risen without you really understanding that the price is going up. Because the last thing you want is for your agent fees to keep growing, but your rent income isn't growing, and therefore you're diminishing your return on your property. So tip number 5 is similar to the previous one, but this time you're wanting to make sure that you're negotiating your interest rate with your bank. So again, every so often, give your banker a call and say, can you do me a better rate? Because I'm looking at potentially shopping around and I've seen some cheaper rates elsewhere. Straight away, this will get the bank going, oh, we don't want to lose this customer, and therefore let's look into what their product offering is and can we do any better. If they're not interested in that, maybe they're not the right bank for you. So the other thing you need to be careful with the interest rates is having an understanding of what rate you're paying and what product you have. So there's a difference between the interest rates that are quite often advertised, because quite often they're for owner-occupied houses, and they may be a higher rate for investment property houses. So you need to understand this when you're looking at rates that are advertised online or in person. And the other thing you need to understand is, are you on an interest-only rate or whether it's a principal and interest rate? Because quite often these will be two separate rates. So you don't want to have your rate at, say, 3% and go, oh, I can do better because I've seen it advertised at 2.2%. You go for all the swap over and then you realise, oh, hang on, their investment property rate is actually 3.5%. So as the typical saying goes, you want to be comparing apples for apples, not apples for oranges. But your interest is quite often your largest expense on your property, so you really want to make sure that you're maximising your return by ensuring you're paying the lowest interest rate possible. Alright, there's 5 simple tips that I hope have helped you. As you can see, they cover a range of things such as maximising deductions, minimising capital gains, and then also just reducing general expenses by negotiating with the third-party providers. I really hope this video has provided value for you. I'll be doing another video soon on how does tax work on rental properties, because it's a common question I get, so stay tuned for that soon. As always, thanks for watching and I hope to see you on the next video.